Broadcasting live from the IRSMedic studios, it's Parental Advisory. And welcome to Parental Advisory. We are live talking today about foreign tax treaties, and this is one we needed some help on. So we're joined again by attorney Robert Hanson. Welcome, Robert.
Thank you for having me.
I think you should become a regular.
Okay.
Like every Monday
This is
Robert Hanson Day?
I think we're setting the trend here.
Excellent.
Absolutely. Attorney Robert Hanson, one of my most favorite people in the world. Brilliant mind all around. Very deep individual, just not on taxes, but also on... you're a little of a budding theologian.
Maybe. More, if the bar to be a budding theologian in the United States is a very low bar, so sure.
Well, it's a bud. It's
Yeah.
a bud. It's very small.
Yes.
And that's where I'm hoping it's, because I consider myself one too, but I don't put nearly the intellectual effort that you do in. So, yeah.
God help
if
us
I'm
today.
claiming, right.
Oh, God.
Oh, boy.
Okay.
So, we're going to be talking about tax treaties. And then you said foreign tax treaties.
Yes.
Well, I guess they all have to be foreign.
Pretty much.
Because we can't have a tax treaty with, well, no. Is there a Native American tax treaty?
The treaties that we're going to be talking about are probably a different animal than the different ways that the taxes that international taxation works with Indian tribes.
Got it. Now, the IRS.gov definition of a tax treaty, the United States has tax treaties with a number of foreign countries. Under these treaties, residents, not necessarily citizens of foreign countries, are taxed at a reduced rate or are exempt from U.S. taxes on certain items of income they receive from sources within the United States. Wow. I love how the IRS just makes everything so crystal clear.
Well, and they also don't say with a number of other countries. They could say with a number of other countries. They have to call them foreign.
Yes.
Those foreigners.
I said a simpler definition is two countries' agreements on taxation used to help avoid double taxation and fiscal evasion. Right? So you want to make sure you're not double taxed, and they want to make sure you're not screwing them.
Basically.
The really simple way. Now, what I thought was interesting, too, is you had mentioned, Robert, that this affects federal tax only. State tax is not affected at all.
Correct. With our federal system of government, in which our Constitution set up the different layers of government between federal government, state governments, and your local county governments, the treaties themselves affect only national, federal level taxes. Your state level taxes, reporting requirements, what is taxed, what is not taxed, are not affected by the treaties. Notable is California. I believe California requires unitary reporting for foreign corporations, where if you have a bunch of subsidiaries, you file one consolidated tax return, whereas the federal government is committed to doing arm's length transactions. So basically, if you have a subsidiary and there's an arm's length transaction, meaning that I sell it to you, my subsidiary, at like a normal market rate, then that's allowed, that's okay. But California says, no, we're going to all do it as one big return. If you have a country that has not a federal system, local cantons will also be affected by the treaty.
Got it. And then this is why we need you here, interpreting the treaties. I didn't realize it was such a difficult thing to interpret. When you started talking about, first you have to figure out, the very first thing you do is, do you check to make sure it doesn't have a savings clause?
You check to see what is in the savings clause.
Okay, and what is a savings clause?
The savings clause is basically the United States saying that if you're a U.S. citizen, and that's the number of the scenario that we run into more because we deal with a lot of individuals. If you're an individual citizen of the United States, you can pretty much stop reading the treaty now because we get to tax you as if this treaty did not come into effect. Essentially, the savings clause carves out a large majority of the tax treaty, and then there's some clawback provisions that say, well, okay, we'll still honor a few sections in this large document for things like pensions. Usually, you see a lot of that clawed back in.
Yep. Oh my good Lord.
So we can agree that this is one of the craziest things in the world.
They're a pain to go through.
Right, because here's a treaty that's a law. Okay, ignore all this law, but you don't have to ignore this part.
Right.
There you go.
Perfect.
Wow.
Okay. All right. Now, then we have to talk about the contracting state and the second contracting state and the other contracting state.
Right.
And I thought your take on this was awesome, that you literally print out the treaty and cross things out.
Yes. The treaties are written one time. So if there's a U.S.-German tax treaty, it's not going to have two versions where it says, if you're in the United States, and then there's German income, and they're not going to flip it and reprint the whole thing saying, if you're in Germany and there's U.S. income. It's going to say something to the effect of, a resident of the first contracting state who has income sourced out of the second contracting state, and so on and so on. That's hard to kind of get through. The first time through it, you kind of think, like, what are they talking about?
Like halfway through, you're like, oh, crap, I have to start over.
You have to start all over again?
Start over.
And I like reading things in paper. I like having it in my hand and being able to go through it with a pen and paper. So I will have to print out the treaty sections that are relevant to what I'm doing. I'm going to go say, okay, resident of the first contracting state. I'm going to go, okay, so I know that I have a client living in the United States. So I'm going to cross out first contracting state and write above it United States. And then the second contracting state, I'll write up above that Germany.
Right.
And then I'll do that throughout the entire thing to just get like my mind around clearly what does this section do for me or not do for me.
And how long are they generally? I mean, are you talking 10 pages, 20 pages?
No, probably. There's usually around 30 sections, and each section can run from anywhere between a paragraph to like a page or two. So you're probably looking around 20 to 30 pages just for the treaty themselves. That doesn't include the protocols or any exchange of notes or understandings.
This is one of the reasons why there's tax preparation firms around the world who will say they'll do any tax return. This is one of the reasons why you might not want to pay $400 or $500 to have your foreign tax done, especially when we talk to a hot topic trending on our website right now is the taxation of foreign pensions, which a lot of people are getting surprised with that right now.
Yep.
Robert, I want to go back to something you mentioned earlier. You said that the treaties only affect federal income tax, but now aren't a lot of state taxes based on what your federal adjusted gross income is?
A lot of them are, yes.
Right. So that if you think about it, a lot of these states tax you on worldwide income for income not derived from activities within the state.
If there is some apportionment that can happen, sure.
Right. And we know and I know you were the one who shared this information with me, the root cause or the foundation for worldwide taxation, worldwide tax jurisdiction of the IRS is which war? You told me. You were the one who told me.
I told you that?
Yeah. Or at least one of the books I borrowed and never gave back to you.
That might have been it. Probably World War I is probably when it started. But
I guess that's why you don't lend me books, because you won't find out the answer.
Yeah.
The Civil War. The worldwide taxation, the universal tax jurisdiction, the Revenue Act of 1862, it was worldwide tax jurisdiction because the Union was concerned that many rich Yankees were leaving the U.S. and saying, not only am I not going to fight in your war, I'm not going to pay taxes to support it. So they say, all right, you little draft dodger, you're going to take off of me? We're going to tax you. And that tax finally went away in 1888?
1870s. It was, they promised it was only going to be around for about 10 years. They took it out around 10 years, and then they reinstituted a second federal income tax.
That was knocked down.
Which was struck.
Right. But what happened was that whole idea of worldwide taxation was still stuck in the brain of everybody who passed the income tax. Of course, we would be taxing on personal basis because that's what we've always done as far as we've known. And it's all thanks to the Civil War.
There you go.
And Abraham Lincoln. That rail splitter, whatever that means. I don't know. Yeah, right. Whatever.
All right, I want to take a quick break, and then I want to come back and ask Robert a few more questions, trying to wrap my head around this foreign tax treaties. We'll be back right after this. The IRS takes us serious because we are serious.
We've earned our reputation, and we will protect our reputation.
The IRS knows exactly who we are.
We're full-time advocates, not part-time middlemen.
We are creative problem solvers, not dull form fillers.
We're lawyers, the others, they're not.
IRSMedic, the law offices of Parent, and Wynn, LLP. Real tax attorneys for tough tax problems. And we Back live talking about foreign tax treaties. And we have one of our very own attorneys in-house here, Attorney Robert Hanson, to help us understand tax treaties, foreign tax treaties, which they all are. And when you started talking about tax treaties in the meeting we had last week, you first started talking about the protocol and then clarifications and then exchange of notes. What are all those what does that all mean?
So the protocols usually are supplements to the full treaty themselves. The protocols themselves are a type of treaty. And they have to get entered into with the same type of rules and regulations and procedures as a normal treaty. The exchange of notes are exactly that between the two parties that created the treaty. Here's our notes of understanding. If there's something in the treaty that might be a little ambiguous, a little unclear, you would then go to the protocol to get some more clarification, something a little more fleshed out, a little more concrete. And then first, not every treaty has an explanatory notes available. But for example, if you have, if you renounce your citizenship and the IRS determines that you're doing this for, or you might be doing this for purely tax evasion purposes or tax avoidance purposes, really, they can say that we're going to ignore that and treat you as a U.S. citizen for the next 10 years.
Oh, wow.
If it's not due to just pure tax avoidance purposes, then they won't do that. And there's really nothing in the treaty or even in the protocol that is very clear about what would count as a legitimate purpose. In the explanatory notes for some countries, it'll say something like, here's what we mean by a good reason for renouncing your citizenship. So in the explanatory notes, you got to go all the way down to find something relevant, something more a little crystal clear.
Wow.
Question on the protocols. That now the tax treaty has to be ratified by the Senate.
Yes.
Does the protocol get ratified too, or is that just?
My understanding is that it would be, since protocols are treated just like treaties.
It would
They're
have
treaties
to be,
by any
right.
other name.
That would
So they
be
can't-
interesting.
They can't sneak anything
But then
in.
the exchange of note is not. The exchange of notes is not part of the treaty. That part is not ratified.
That would be separate. If you go to the IRS website, they do have a page where they will link to all the different treaties they have with all the different countries. And if you click on, for example, the United Kingdom, it'll take you to a page that will have a link for the old treaty, because the treaties generally have a 15-year lifespan, not just for U.S. treaties, but the UN has their own model treaties for taxes, the OECD has their own model treaties for taxes, and all those countries have treaties with each other for that type of stuff. So treaties overall have a 15-year lifespan, roughly. If you go to the websites, you'll see maybe the 1978 version of a treaty, then you'll see the 2001 version of the treaty, and each will have their own protocols. Each will have their own explanatory notes, sometimes, not always. Some will have multiple protocols. So that's where you would find all that information. There's a lot.
So they leave the old ones up?
They leave the old ones up.
That's weird.
Well, there's an obligation to the IRS. If you don't file a tax return, the IRS has forever to assess you the
that's
tax.
true.
And that's why when we were looking for old tax 1040s from as far back as I wanted to see what they put down. Well, before the Social Security number, what did you put down on a tax return to identify yourself? And you put down your name and address.
Yeah.
And I was looking at a 1926 tax return. So all these returns, you can find them online on irs.gov.
GOV, which is a really easy to use, very easy to understand
That's
website.
right.
Very, very easy. And then a few questions you also want to ask. Now, this is stuff that I think you guys would just know, but if you're talking about just an average Joe trying to figure this stuff out himself, questions, what's the source country? Who sets the tax law? Where did the income tax arise? Is it citizen versus source base? And this is all stuff that you guys figure out going into looking.
Yeah, in this, the citizen versus source base or territorial base is usually pretty easy to figure out. The U.S. is the only country in the world with a few limitations, and once I explain those limitations, it basically does support my proposition. The U.S. is the only country in the world that taxes its persons on a worldwide basis.
Yes.
Now, people will always say, well, there's that African country of Eritrea, and I did take a look at their tax return, which is one page, and there's actually a seal of a camel on it. I'm serious. And it doesn't look like, while it says that on Wikipedia, I'm not so sure they know that. I don't think they know that there's worldwide taxation. So, okay, a little bit, and it's maybe not quite a country. It is there. It definitely shows up on a map, but there doesn't seem to be a lot. I mean, it was only one of those countries I've learned about because that's the other example.
Yep.
And then the other one that people give as an example is North Korea.
Because that's a
Right.
that's a model you want to follow.
Right, but North Korea has a whole. It's not true. North Korea does not tax its citizens on its worldwide income. North Korea is a tax haven. There is 0% tax for North Korean citizens. Now, what happens if you're a non-North Korean person in North Korea? Now your worldwide income becomes taxable to North Korea. I don't know how many people in the world choose to live in North Korea, and I don't.
Just for the tax.
I
break.
mean, right? I guess if Dennis Rodman played a few games there, hey, thanks for playing. Here's your tax bill, buddy.
Yeah.
Yeah.
It's not like going to St. Kitts, or something like that.
Yeah,
Right.
Yeah. So he was a big fan. Maybe that they would probably be surprised too, guys. That's actually your law. You can actually tax them. So that's really why the U.S. stands alone from every other country. That's one of the reasons why people find the U.S. so obnoxious, rightfully so.
Yeah.
When their entire life they never ran into a tax regime like we have here, because there is no other tax regime like we have here.
We're sort of bullies. And we'll take one last quick break and talk about how we are bullying other countries into giving us information, and also how this affects individuals differently than actual corporations right after this.
Claudine, would you believe that there is always going to be somebody who charges less than IRSMedic, the law offices of Parent, and Wynn?
I guess, but isn't it important that the problem be fixed once and be done correctly?
How about having your filings done as accurately and completely as possible?
Isn't it important that we anticipate the wrong things the IRS may do and have an action plan in place to fix them?
Do you want to feel emotionally secure throughout the whole process?
Do you want to ensure that you aren't billed for communicating with us?
Is it important that you can exchange documents securely with your law firm?
Is it important to you that your tax filings not be blown up years down the road when the IRS discovers sloppy mistakes?
Do you want a law firm that will anticipate the mistakes you might make and educate you on how to avoid having an IRS problem ever again?
Do you want someone that's on your side?
Do you want someone who will treat you with respect and know that we are with you till the end?
Is it important to know that any legal work is guaranteed and warranted?
Is it important to know that we give a shit?
IRSMedic, the law offices of Parent, and Wynn, LLP, real tax attorneys for tough tax problems. And we're back on Parental Advisory with our guest, Robert Hanson, attorney Robert Hanson, talking about tax treaties. And we've been talking so far basically about tax treaties as it applies to individuals.
Right.
But with large corporations here at Parent, and Wynn, LLP, we don't really deal with corporations and tax treaties.
No. Large multinational corporations are going to have their own in-house counsel. And that's really quite a job to have. They pay, the job pays well if you're the tax director of a Fortune 500, even a smaller company. Smaller, I'm saying that in quotes because it's still a large company. Mm-hmm. It's a well-paying job, but it's a job that I would never want to have, because when I do review what they're talking about on some of my paid subscription services, I see what they're talking about. And it's sort of a stomach-churning career because they're set a goal by management of something like, well, the industry standard is only 4% taxes that we're going to pay to the U.S. Whatever, make it happen and make sure we don't have to do anything criminal to do it.
But isn't the tax rate for corporations like 35%?
It's the highest in the world, yet that's what
Wow.
large... Now, here's the word we want to use is multinational corporation.
Right.
Not dual national corporations, but multinational. It's really not a U.S. Fortune 500 company who's filing it. They will funnel and move the money around. So really you're talking about a company that's headquartered where? And you were talking about Norway, right? You were talking about one company who approached Norway to say, okay, we'll move our headquarters here. We want to know what our tax deal is going to be.
Right. You can get, through the use of advanced pricing agreements, transfer pricing. If you're not a U.S. incorporated company, if you're like, for example, a U.K. incorporated company who has, it's like we were talking before, there are UN and OECD type treaties with other countries. If you're located there, you're not a resident of the United States. You're a resident of that other country. So you can have U.S. source income, but if you have a treaty that is with another country other than the United States, you can have money funneled through there using, your own corporate structure to reduce your tax rate. And it's something that, as an individual, you can't do.
Right. I would say, to me, it always seemed like it was the geometric proof, or was it? What is that
I used
word?
to love those geometric proofs.
A equals B, B equals C, therefore A equals C. And you're just sort of using things as stepping stones to get to where you want to be. And that's, I think, the easiest way to understand it. Now, sometimes you might have to use a whole bunch of stepping stones to get where you go. And sometimes it doesn't go quite in a straight line.
Right.
And that's why, the people, command the salaries that they do. It's a lot of hard work, and the pressure is intense because there's always some temptation to maybe, let's see if we can get away with it. And as soon as you're talking about the money involved, it's going to be substantial. The IRS is going to have a problem with it. They may recommend, criminal prosecution, not usually, but sometimes they'll put fraud penalties on, and then that litigation goes on forever. And there's usually careers. Some of these cases can take 10 years to develop.
Wow.
And, just sort of fighting, and it's a substantial amount of money, where you're talking about billions of dollars because this issue has been sitting around for so long, the interest has been growing, and the time to collect has not been told because it's been assessed. So there's still all this time to collect. The corporation has the assets to, in a liquidation to grab it. The IRS could grab it all. So this is the pressure and the intensity, and that the stakes are so high. The IRS puts teams of people on to these, and they have their things, and it's just such high value that this is where people are always going to screw around because the value's there. It's just worth it. And then you sometimes hear, I've definitely heard my share of people telling me what companies are doing that management doesn't know about.
Oh.
That there's things going on because there's maybe the high manager doesn't know about it, but the middle manager knows because he's reportable because his boss said, hey, we got it. We can't pay more than this in tax.
Yep.
And so that middle manager is now telling people to funnel money through ways. And I've definitely heard that goes on a bit.
Wow.
I would say based on my own, things that people tell me.
Yeah.
And it doesn't necessarily get caught either.
Not yet.
Yeah, right, yeah.
Because they're going to get caught.
Well,
so you don't think?
There's so much of it. And, again, you have your statute of limitations. For the IRS, when they're going to, there's the LB&Is, large business and international. And that's the area that we're talking about here with tax treaties for individuals and for large businesses. That's an interesting outfit. And that's really, I think, probably one of the coolest places to work because you tend to deal with corporations and high value things. There's a whole team on everything, and you just don't have an examiner who's going in to do that. But there's a whole team, and they meet and they do an assessment risk to see, okay, well, what do you think we're going to get out of this if we put these incredibly highly trained people that are that are very scarce? There's not enough auditors to go around. There's simply not. These are very talented people. And you don't find them everywhere. You don't find this level of talent of people who are like, yeah, I'll work at the IRS. Yeah, that sounds like great. I love it.
Fantastic.
There's people who like it, and there's people who can't tolerate it. And there's just not enough talented people that are willing to do it. So they have to manage their resources. And so a lot of stuff does go by. And I don't think the IRS is ever going to tell you. They're never going to tell you like, oh, yeah, we missed a lot of stuff because there's no way we have enough people. It's not something they really want to
That's not a press
get
release.
out. Right, it's not. But when you look at the limitations that they have, when you look at the actual administrative limitations they have, there's no way they're able to do this. And when you look at a large corporation on that, a large corporation might not know what middle management is doing, and it won't know what the end employee is doing either.
Yep.
Nobody really has control. There's not enough people to go around entirely. So a lot of stuff is not getting caught.
Perhaps gets missed.
Yes.
Yes. Some of the things I was reading about was basically like treaty shopping. Like these country or companies will go around and say to each country, who's going to give us the best deal? And you had mentioned Norway.
Right.
And what they're finding is now something called tax inversions. And you had mentioned briefly Pfizer and Ireland. And I thought, let me look into this. And I thought it was really fascinating. Pfizer, who's known most for Viagra, aren't they?
One of the many drugs that they
believe so. And then
put on the market.
There's another company called, is it Allergen? and they make Botox. Never tried it, but two interesting sort of companies that would like to merge.
I've got an earful from Pfizer employees because they're around here. Mm-hmm. Oh my God, it's scary. Mm-hmm. They definitely want to come out with products that you don't use once and you're cured. Mm-hmm. Let's just say that.
Yeah.
They don't want to make themselves obsolete. It's an interesting business model.
Yeah.
That's somewhat frightening.
So a tax inversion is where an American company agrees to be, quote unquote, taken over by a smaller foreign firm, and then they switch their tax residency to the country where the foreign company pays its taxes. So in the case of Pfizer, they're saying, now Pfizer is estimating themselves. They're saying, we think this is going to save us about $1.2 billion a year. And from what I was reading, they're like, that's grossly underestimated.
Yeah.
They think it's probably about 3 times as much.
Right.
So Pfizer's going to save potentially up to $3 billion a year.
Again, they're not going to tell you exactly what it is because they're thumbing their nose. Well, we're really not going to get away with that much. And that's what we're always dealing with in the tax world is no one's really telling you the truth. The IRS isn't going to tell you what people are really going to get away with because that's only going to alert people how to get away with it. Pfizer's not going to tell you like, hey, look at what we're getting away with because that's going to raise... like, oh, no, we're paying. We're totally paying. Just like everybody else. We're doing our fair share.
Well, we mentioned you go first.
Oh, okay.
You're the guest.
Oh, thank you. And those type of things I want to say trickle down through the industry. Yeah, one company does something like that. Google does their treaty work that comes out in the news a couple of years ago, and a CEO will call up their tax department and go, "This is ridiculous. Can we do this?"
And because they said that the how this isn't true is they say, well, the corporate tax rate is 12.5% in Ireland. They're not paying 12.5%. They're not, because it better be 4%. Otherwise, you're fired. Mm-hmm. That's not going to happen, and that's what you can kind of see in these meetings. They're all talking about this and sharing, like, "Oh yeah, we tried this at work. It totally worked. Right. Oh yeah, dude, check it out."
And it's definitely becoming more popular because they said that, I guess McDermott International started this back in about 1982. They switched to Panama. And since then, 50 countries have switched their registration to low tax countries, but 21 of those have been in the past 3 years. So it's like somebody went, oh, wait, this is a good idea. We should all do this.
Right.
Well, and I'm looking at your notes for today's episode, and now you've totally... confused me because you said, well, including Burger King, who's gone to
Canada.
Okay,
Canada.
Then you said this. Then you say this one, Tim Horton.
You didn't know about that?
Isn't he Canadian? I thought he was already Canadian.
I think he's Canadian. Somehow they had based it in the U.S. and then eventually switched back.
I feel like I've been lied to. Now I feel I'm not being lied to. Now that they're Canadian.
Right.
Okay, now I can go. But all those other times I've went, they went to Canada. Well, that makes sense.
Yep.
Well, Robert, we were talking about that, people kind of like, well, let me go offshore to avoid the taxes. And, this, they see the inversion, and the Dutch sandwich that people think they can do. And that somebody's going to sell them, well, here's your tax shelter by going offshore. You and I have talked about this a bit. And then it was actually Sean O'Connor who said this at our meeting.
Smart guy.
One of our, incredibly smart guy, another attorney here. And he said, I was trying to say, if you want to know what the tax law is, you think like a politician. He added to that. He said, just think about who the strongest lobby is on any particular issue. And I think his is closer to the truth. Mm-hmm. And we look at, okay, is there a lobby for Fortune 500 companies? Mm-hmm. Is there a lobby for Fortune 100,000 companies? Mm-hmm. How about, is there a lobby for the small-time investor in D.C.? Yeah, there's nobody there.
No. Right.
And so that's kind of, I think, how you answer your question about, well, can a small individual or even a medium individual, a non-multinational Fortune 500 person, do the things that a multinational does? The answer is no.
No, and if somebody comes to you promising that's not somebody you want to be involved with. If you have somebody promising to keep the IRS at arm's length, perhaps that's not a company you want to deal with.
If it was only that way, to give them the stiff arm. No, IRS, you can't go
look at my clients.
Yeah, it doesn't work like that. They're going to come in and you have to, comply with them, and there's no other way around it. except, gambling, which may work, I guess.
We'll let you know shortly.
Not advised.
Yeah, we'll just say it once. We'll say it again. You can't out IRS the IRS.
That's right.
There's no way. Well, Robert, thank you for coming in and clearing things up.
I appreciate
I'm
you having
learning
me.
every day. So maybe next Monday we'll have coffee again. We'll talk.
Little coffee
A little,
and cake.
Little
little
coffee.
Tim Hortons in celebration. Now, and I haven't asked you this, but is there one tax treaty that sticks out in your mind? Is there, or do they all seem kind of the same? Is there one that maybe you like the font or the artistic styling of the writing, or you think it's just done poetically? Are there one or any that stick out at all?
For the aesthetic quality, no. No, none. For being slightly less terrible for our clients, the UK treaty.
Okay.
That's one step.
The UK treaty.
With an asterisk that if you're working with the UK treaty, perhaps you want to check the UK website.
Maybe that's a story we should.
There's the other story. Yeah, I think we could tease that story about why you might want to go to the UK, not the IRS.gov, to find the real tax treaty. And you can actually find that article on IRSMedic.com. There is a fake treaty up on the IRS, and there's the real one on the UK.
That our very own Julia found.
That our very own Julia found. And the UK-US tax treaty is the one with the longest history, 18 and 14. I pulled out of my butt the other day, and I think I was right. I think someone's like, yeah, actually, you're
That's right.
Yeah. Which ended the War of 1812, or was part of the
Ending.
Treaty of Ghent package, I think.
That's right. Treaty
Yeah.
of Ghent.
I know. I pulled that out, too.
Impressed.
We're just so smart over here. We can't even handle ourselves. All right. Well, thanks for joining us on Parental Advisory. Thanks for joining Parental Advisory, hosted by Anthony Parent, produced by Claudine Gindel, that's me, engineered by Chris Chen. For more podcasts, visit our website at parentaladvisoryshow.com and like us on Facebook to submit story ideas. We'd like to thank our sponsors, IRSMedic.com, the law offices of Parent, and Wynn, LLP, real tax attorneys for tough tax problems.